We are living through a monetary moment that happens perhaps once in a generation. While most people scroll past headlines without a second thought, a profound shift is unfolding in the global financial system. Gold and silver prices are not simply rising. They are breaking through levels that reflect something deeper, a loss of confidence in the very foundation of modern money. This is not speculation. This is not about getting rich quickly. This is about understanding what happens when the world's trust in fiat currency begins to fracture. For decades, we've operated under a system where currencies are backed by nothing more than government promise and central bank policy. That system has delivered unprecedented prosperity for many, but it has also accumulated unprecedented debt, unprecedented money printing, and unprecedented distortions in asset prices. Now, the oldest forms of money, physical gold and physical silver, are speaking loudly, and when precious metals rise in this particular way, against this particular backdrop, history tells us to pay attention. If you hold these assets already, you need clarity on what you're holding and why. If you're considering entering these markets, you need to understand what you're actually buying and what risks you're taking on. This video will give you both. Not hype, not promises. Just clear analysis from someone who has watched these cycles unfold over decades and who understands that wealth is not built on excitement. It is built on knowledge, discipline, and emotional control. The question before you is simple. Do you understand what's happening? And more importantly, do you understand what to do about it? Let's begin. To understand why gold and silver are rising, you must first understand what they're rising against. A fiat currency is money by government decree. It has no intrinsic value. It cannot be redeemed for anything tangible. Its worth exists purely because a government declares it legal tender, and because people collectively agree to accept it. This system has advantages. It allows central banks flexibility. It enables governments to respond to crises by expanding money supply. It has facilitated global trade and economic growth on a scale previously unimaginable, but it also has a fatal flaw. There is no limit to how much can be created. When governments face impossible choices, fund a war, bail out a banking system, stimulate a collapsing economy, the printing press becomes irresistible, and every time money is created without corresponding production of real goods and services, the value of each existing unit declines. This is not theory, this is arithmetic. We have seen this pattern before many times across many civilizations. The Roman Empire debased its currency by reducing silver content in coins. The result was inflation, economic chaos, and eventual collapse. The Weimar Republic printed money to pay war debts. The result was hyperinflation so severe that people burned cash for heat because it was cheaper than buying firewood. More recently, Argentina, Venezuela, Zimbabwe, and Turkey have all experienced currency crises driven by excessive money creation and loss of confidence. The United States and other major economies believe they are different. They point to their status as reserve currencies, their sophisticated institutions, their deep markets. And to a degree, they are correct. These factors do provide a buffer that smaller nations lack. But the buffer is not infinite, and we are testing its limits. Here's the reality that keeps serious analysts awake at night. The developed world has accumulated debt that cannot be repaid under any realistic economic scenario. Government debt to GDP ratios in the United States, Japan, and many European nations have reached levels historically associated with default or severe inflation. When debt reaches these levels, governments face only bad options. They can attempt to pay it back honestly, which requires either massive tax increases or severe spending cuts, both politically unacceptable and economically devastating. They can default outright, which destroys credibility and access to capital markets. Or they can inflate it away, creating new money to pay old debts, gradually eroding the purchasing power of the currency. History shows us that governments almost always choose the third option. It is slower, it is less visible to most people, and it allows them to claim they are honoring their obligations while quietly destroying the value of those obligations. This is not a conspiracy. This is simply how the incentives work. Gold and silver are rising because they are the antithesis of fiat currency. They cannot be printed. They cannot be created by decree. Their supply grows slowly, limited by the physics of mining and geology. For thousands of years across every civilization, they have been recognized as stores of value precisely because of these properties. When confidence in fiat currency weakens, capital flows toward these alternatives, not because of their beauty or industrial use, though both matter, but because they are outside the system that is showing signs of stress. Think of gold and silver as financial smoke detectors. When they alarm together, loudly and persistently, the wise investor investigates rather than dismisses. Let us examine the specific conditions driving today's movements. Central banks globally have expanded their balance sheets by trillions over the past 15 years. The response to the 2008 financial crisis involved unprecedented money creation. The response to the 2020 pandemic dwarfed even that. Inflation, which authorities assured us would be transitory, has proven persistent. Even as headline numbers moderate, the damage to purchasing power is permanent. A dollar that has lost 20% of its value does not recover that value when inflation slows. Interest rates have risen sharply in an attempt to control inflation, but this creates a new problem. The cost of servicing massive government debt becomes unsustainable. Every percentage point increase in rates adds hundreds of billions to annual interest payments. This is the trap. Inflation requires higher rates, but higher rates make the debt unserviceable. The only way out is to eventually restart money creation, which brings back inflation. We are watching this dynamic play out in real time, and markets are beginning to price in the inevitable outcome. There's also a psychological component you must understand. Markets move through predictable emotional cycles. In the early stages of a bull market in precious metals, most investors are skeptical. They remember past disappointments. They hear experts dismiss gold as a barbarous relic. As prices rise and the underlying concerns become harder to ignore, more investors begin to pay attention. This is where we are now, moving from skepticism to growing awareness. If the problems intensify, we enter euphoria, the stage where everyone wants in. Prices spike dramatically and rationality disappears. This is when fortunes are both made and lost, often in rapid succession. Understanding where we are in this cycle is critical to making sound decisions. We are not yet in euphoria, but we are past the point where intelligent people can ignore what's happening. Gold and silver are not moving in isolation. We are seeing volatility in currency markets as traders lose confidence in central bank guidance. We are seeing unusual patterns in sovereign debt markets as investors demand higher yields to compensate for inflation risk. We are seeing capital flows out of regions with weak fiscal positions into perceived safe havens. We are seeing central banks themselves, especially in Asia and emerging markets, buying physical gold at the fastest pace in decades. These are all pieces of the same puzzle. When you step back and view the whole picture, a clear image emerges. A monetary system under severe strain, with investors beginning to hedge against outcomes that were once considered impossible. This does not mean the system will collapse tomorrow. Large systems have enormous momentum and resilience, but it does mean the risks are elevated and rising. And in such an environment, the oldest forms of wealth protection become not speculative, but prudent. If you have been holding physical gold and silver, or investments tied to these metals, you may be feeling vindicated. You may be tempted to view rising prices as confirmation that you should add more exposure. Pause before you do. First, revisit why you hold these assets. If your reason was portfolio diversification and protection against currency debasement, then your thesis is playing out. That does not automatically mean you should concentrate further. If your allocation to precious metals was 5 or 10% of your portfolio, and it has now grown to 15 or 20% through price appreciation, you are already more exposed than you planned. This is not wrong, it simply is, but it means you should be more cautious about adding, not less. Professional portfolio managers face a constant tension. Do you trim winning positions to maintain balance, or do you let winners run? There is no universal answer. It depends on your timeline, your conviction, and your ability to tolerate volatility. If you are 10 years from retirement and precious metals have appreciated significantly, taking some profits to rebalance is rational. You lock in gains and reduce concentration risk. If you believe we are in the early stages of a multi-year move driven by fundamentals that have not yet fully played out, maintaining or even increasing exposure may make sense, provided you can emotionally handle the volatility. What you must not do is hold blindly without reassessing your reasoning. Markets change. New information emerges. The case that was compelling 6 months ago may have evolved. If you hold physical metal, coins, bars in your possession, or an allocated storage, you have maximum security but minimum liquidity. This is appropriate for long-term holdings meant as insurance, not for trading. If you hold mining stocks, ETFs, or futures, you have exposure to price movements but also to counterparty risk, management risk, and leverage risk. These instruments can multiply returns but also magnify losses. Many sophisticated investors hold a combination: physical metal as the core, immovable position, and paper instruments as satellite positions that can be adjusted tactically. The most dangerous mistake current holders make is assuming that because an asset has risen, it must continue rising. Gold and silver can be volatile. Corrections of 10, 15, or even 20% are normal within larger bull markets. If you have become accustomed to checking prices daily and feeling euphoric with every uptick, you are setting yourself up for painful emotional swings. Decide your strategy now while you can think clearly. Write it down. Define in advance what would cause you to sell, what would cause you to hold, and what would cause you to add. Then execute that strategy without constantly second-guessing yourself based on short-term noise. Rising prices create tax implications. If you hold precious metals in taxable accounts and realize gains, Be prepared for capital gains taxes, which can be substantial depending on your jurisdiction and holding period. If these assets represent a significant portion of your net worth, consider estate planning implications. Physical assets must be properly documented and secured. Heirs need to know what exists and where it is located. These are not exciting topics, but ignoring them can result in unnecessary losses that offset the gains you worked so hard to achieve. If you have been watching from the sidelines and are now thinking about establishing a position, you face different questions. Why are you considering gold and silver? Be honest with yourself. Are you trying to protect existing wealth against currency debasement? That is a legitimate, time-tested reason. Are you diversifying a portfolio that is overconcentrated in financial assets like stocks and bonds? That is prudent risk management. Or are you chasing returns because you see prices rising and fear missing out? That is speculation dressed as investment, and it rarely ends well. Your purpose determines your approach. Insurance and diversification suggest modest, permanent allocations. Speculation suggests trading with capital you can afford to lose. Before you invest a single dollar, understand what you're buying. If you are considering physical metal, learn about premiums, storage, security, and liquidity. Understand the difference between bullion and numismatic coins. Know what you will pay to buy and what you will receive when you sell. If you are considering mining stocks, understand that they are leveraged plays on metal prices, but they also carry operational risk, geopolitical risk, and management risk. A rising gold price does not guarantee rising mining stocks if a company faces labor disputes, regulatory problems, or execution failures. If you are considering ETFs or futures, understand the structure, the fees, and the risks. Some gold ETFs hold physical metal, others hold derivatives. The difference matters. One of the most common mistakes new investors make is entering with too much capital at once, especially after prices have already risen significantly. Consider dollar cost averaging, making smaller purchases over time. This reduces the risk of buying at a local peak and forces discipline into your process. Yes, you might miss some gains if prices continue rising, but you also protect yourself from devastating losses if a correction occurs. When you are building a long-term position, the exact entry point matters less than whether you can hold through inevitable volatility. Gold and silver can rise dramatically. They can also fall dramatically. In 2011, gold reached $1,900 per ounce, and then declined to below $1,100 over the next 4 years. Silver has been even more volatile, with drawdowns exceeding 50%. If you cannot stomach watching your position lose 20 or 30% of its value without panicking and selling at the bottom, you should not establish a position that is large enough to create that stress. The correct position size is one that allows you to hold through volatility because you understand and accept it as part of the asset class. Precious metals markets offer extensive leverage through futures, options, and leveraged ETFs. This means you can control a large position with a small amount of capital. This also means you can lose everything quickly if markets move against you. Unless you are an experienced trader with risk management systems in place, avoid leverage entirely. The potential for amplified returns is attractive, but the reality is that most leveraged traders lose money because volatility stops them out even when their directional view is ultimately correct. A traditional portfolio recommendation is that 5 to 10% in precious metals provides meaningful diversification benefit without creating concentration risk. If you are particularly concerned about monetary instability, you might go higher, but once you exceed 20%, you are making a concentrated bet rather than a defensive allocation. That may be appropriate for your circumstances, but understand what you're doing. Remember, diversification works because different assets perform well in different environments. If you abandon diversification to concentrate heavily in one area, even an area with compelling fundamentals, you give up the protection that diversification provides. Regardless of whether you currently hold precious metals or are considering entry, certain behavioral traps destroy wealth consistently. Avoid these at all costs. The most expensive mistakes in investing are made under emotional duress. When prices surge, greed whispers that you must buy more immediately or miss out. When prices plunge, fear screams that you must sell before losses grow worse. Both impulses are usually wrong. Markets are designed to extract capital from emotional participants and transfer it to disciplined participants. If you find yourself checking prices obsessively, losing sleep, or making decisions based on daily market movements, you have too much exposure or insufficient understanding of what you own. Fix this before it destroys your capital. Assets that have already risen substantially often attract the most attention and capital, precisely when risk is highest. In every bull market, the majority of participants enter in the later stages, after most of the move has occurred. They buy at elevated prices because they finally believe the story. Then they hold through a correction or crash, locking in losses. If you're getting interested in gold and silver only now, after significant moves, ask yourself, would I have been interested at lower prices? If not, why not? If the fundamental case was valid, then why didn't you act? If the fundamental case has changed, what specifically has changed? More money has been lost through excessive position sizing than through being wrong about market direction. You can be completely correct that precious metals will rise over the next decade. But if you concentrate 50% of your net worth in gold and silver, and a sharp correction occurs at a moment when you need to access capital, you will be forced to sell at exactly the wrong time. Position sizing is not about maximizing potential returns. It is about surviving inevitable volatility with your capital and your conviction intact. Precious metals are one piece of a broader wealth protection strategy, not the entire strategy. They perform well in certain environments, particularly those involving inflation, currency instability, and geopolitical stress. They perform poorly in other environments, particularly those involving rising real interest rates, strong economic growth, and stable currencies. No one knows with certainty which environment will dominate in the coming years. A diversified approach acknowledges this uncertainty and protects you across scenarios. The precious metals space attracts a particular type of promoter, individuals who speak with absolute certainty about coming collapse, who promise life-changing returns, who sell urgency rather than understanding. These people often have conflicts of interest. They may sell coins at inflated premiums. They may profit from newsletter subscriptions or affiliate relationships. They may simply enjoy the attention and status that comes from making dramatic predictions. Some of their analysis may be sound, but when someone tells you they know exactly what will happen and exactly when, they are lying or deluded. The future is always uncertain. Anyone claiming otherwise is trying to manipulate you. If you hold physical precious metals, security is paramount. Leaving valuable metals in obvious places in your home is unwise. Telling people you own significant amounts is unwise. Failing to insure or protect your holdings is unwise. If you use third-party storage, understand whether you have allocated storage, specific bars or coins owned by you, or unallocated storage, a claim on pooled metal. Understand the company's financial strength and insurance coverage. Understand the jurisdiction where metal is stored and what legal protections exist. Counterparty risk, the risk that someone you depend on fails to fulfill their obligation, has destroyed many investors who thought they owned gold but actually owned someone's promise to deliver gold. These are not the same thing. Even professional traders with sophisticated tools and decades of experience struggle to time markets consistently. The fantasy that you will buy at the bottom and sell at the top is just that, a fantasy. Real wealth in precious metals is built by establishing positions based on sound reasoning, holding through volatility and adjusting only when fundamentals change meaningfully. Every hour spent trying to find the perfect entry point is an hour not spent understanding the assets, managing risk, or building the discipline required for success. Precious metals transactions can have significant tax implications depending on your jurisdiction. In some regions, physical metal sales trigger capital gains taxes. In others, certain coins or transaction structures offer advantages. Some jurisdictions require reporting of large transactions or holdings. Ignorance is not an excuse. Understand the rules that apply to you, maintain proper records, and consult qualified professionals when appropriate. The cost of good advice is trivial compared to the cost of violations or poor structuring. We have covered substantial ground. Let us distill this into clarity. The global monetary system is under stress. Debt levels are unsustainable. Central banks face impossible trade-offs between inflation control and debt serviceability. Currency debasement through money creation remains the path of least political resistance. In this environment, gold and silver are performing their historical function, providing an alternative to fiat currency and a store of value outside the system showing strain. These are facts, observable and documentable. They form the foundation of the current move in precious metals. We do not know how long this dynamic will persist. We do not know whether it will intensify into a crisis or gradually resolve over decades. We do not know whether central banks will successfully navigate these challenges or whether their policies will accelerate the loss of confidence they are trying to prevent. We do not know where prices will be next month, next year, or 5 years from now. Anyone claiming such knowledge is deceiving themselves or you. If you understand the forces at work and believe they warrant protection, precious metals deserve consideration as part of a diversified portfolio. The appropriate size of that position depends on your personal circumstances, your wealth, your time horizon, your ability to tolerate volatility, and your conviction about the analysis we have discussed. If you already hold these assets, now is the time for clear-headed assessment. Are you still comfortable with your allocation? Does your original reasoning remain valid? Are you prepared emotionally and strategically for both continued rises and significant corrections? If you are considering entry, proceed with humility and discipline. Educate yourself thoroughly. Start with modest positions. Avoid leverage. Accept that you will not time this perfectly, and that is acceptable. Successful investing in any asset class requires mastery of your own psychology. You will face moments of doubt when prices fall and everyone around you questions the strategy. You will face moments of temptation when prices rise, and you want to increase exposure beyond rational limits. Your success will be determined not by the accuracy of your market predictions, no one predicts consistently, but by your ability to hold a sound strategy through emotional storms that will inevitably arrive. This is not about intelligence. Highly intelligent people routinely fail at investing because they cannot control their emotions. This is about discipline, perspective, and the humility to acknowledge what you do not know. Remember that wealth is not an end in itself. It is a means to security, freedom, and the ability to care for those you love. Precious metals are one tool for preserving wealth across time and through periods of instability. They are not magic. They will not make you rich quickly. They will not solve problems that stem from poor planning, inadequate income, or lack of financial discipline in other areas, but they can play a valuable role in a thoughtful, diversified approach to wealth preservation. The monetary landscape ahead is uncertain. The stresses we have discussed may resolve peacefully through productivity growth, demographic shifts, and political will to address debt, or they may intensify into something more disruptive. No one knows. What separates the prepared from the unprepared is not certainty about the future, it is readiness for multiple possible futures. Precious metals are part of that readiness, not as a bet on collapse, but as insurance against monetary instability, not as a path to riches, but as a preserve of wealth across scenarios. If this analysis resonates, your task now is clear. Educate yourself further. Read history, understand the mechanics of monetary systems and why they succeed or fail. Look at evidence from multiple perspectives, including those who disagree with the thesis presented here. Assess your personal situation honestly. What are you trying to protect? What risks are you most concerned about? What allocation makes sense given your unique circumstances? Make a plan based on that assessment. Write it down. Define your strategy for different scenarios. Then execute that plan with discipline, ignoring the noise that will constantly tempt you to deviate. We are living through a significant moment in financial history. The relationship between governments, central banks, and the currency system is being tested in ways not seen in generations. How this resolves will shape the wealth landscape for decades to come. Those who understand what is happening and prepare thoughtfully will fare better than those who ignore the signals or react emotionally when events accelerate. Gold and silver are not solutions to every problem, but they are time-tested tools that serve a specific purpose in an environment like the one we inhabit. Your responsibility is not to predict the future with certainty. That is impossible. Your responsibility is to understand the present clearly, assess risks honestly, and position yourself to survive and potentially thrive across multiple possible outcomes. That is the essence of sound wealth management. Not excitement, not promises of easy returns, just clear thinking, emotional discipline, and the wisdom to prepare before events force your hand. The choice, as always, is yours, but now you have the framework to make that choice from a position of knowledge rather than confusion. Consider carefully, plan thoughtfully, execute with discipline, and remember that true wealth is built over decades, not days.